Eddie Ghabour with us this morning. This is a Trump rally. It's happening right now, and the Fed's expected to cut rates this week. So, Eddie, are we off to the races?
We absolutely are, Stuart. I mean, I can't remember a week in my 26 years of managing money that's had such huge market implications between this pivotal election that obviously the market likes this morning, and then you got a Fed that I think is going to make a policy mistake and cut rates this week. So investors need to pivot to this new market regime. It's not really new. It's this Goldilocks post-election rally we've been talking about all year. Now that the election is behind us, I think you need to play offense in regards to the equity markets because this is a Goldilocks scenario.
What are you buying?
So right now, small caps has been an area we've been patient in, and it's been painful to own because it's back and forth. We're glad that we hold it. We're seeing big move in it today. We're not going to buy anything today with the exception of possibly adding to gold. That is down today. I think that's a gift in the sense that the Fed is going to cause inflation to get higher next year. So we want to have that position to increase. But look, we're going to stay overweight tech. We're going to buy more Meta. It's down today. And then we are going to continue to add to small caps because I think that's where you're going to see really the outperformance in the S&P over the next 3 to 6 months.
Do you have an ETF for small caps?
IWM is an ETF that we own right now for clients. We have about a 5% position there. We will be looking to take that to about 10 in the coming weeks. But this morning isn't the morning to buy and jump in on this huge rally. We'll be patient because we're having a great morning with how we're positioned, and there'll be other opportunities to buy in the coming weeks.
In recent months, whenever Treasury bond yields go up, there's a certain reaction in the market. They don't like, investors don't like higher Treasury bond yields. Well, this morning, bond yields have gone straight up. Look at that. The yield on the 10-year is at 4.47, up 20 basis points. That's a huge gain in that yield. And the 2-year on the screen now has reached 4.3%. Now, that's astonishing. Does that worry you?
It does. It worries me because the Fed is ignoring it. What the bond market is telling us right now is expecting growth to accelerate. And that means inflation will accelerate too. And when you cut interest rates, when the market is telling you you don't have to, that adds rocket fuel to risk assets. So short term, it will cause these risk assets to really explode, in my opinion. However, there'll be a big price to pay 6 to 12 months from now because if they do cut rates, it will cause the inflation to accelerate at a faster pace. And that's when you'll have the 10-year over 5%, as I've been saying for the last month and a half. And I think now it's just a matter of when, not if. So I'd rather them just let the market take over and don't cut rates. The economy does not need it. The bond market is giving a crystal clear signal, but I think they're going to ignore it again. So be ready to de-risk when inflation does reaccelerate next year. But in the meantime, it's going to be Goldilocks for these risk assets.
Okay, 30 seconds to the opening bell. Have you got time to tell me what you are selling now that Harris has lost?
Well, fortunately, the only thing we sold was our Treasury bonds ETF last week. We had the Trump trade on. We don't have staples. We don't have defensive assets. We are all in growth, small caps, and the NVIDIA and Meta, as I've been clear on that. So we're just going to add to those positions.
All right, you bought this rally. That's all right to me.